In 2025, big tech ripped higher, led by AI hype and strong earnings. But money crowded into a few giants, pushing index gains into a narrow lane. By late 2025, valuations stretched and expectations became almost impossible to beat. In 2026, investors started asking, how much good news is already priced in? When everyone owns the same winners, even small disappointments can hit hard. That's why some funds began trimming megacap exposure and reducing concentration risk. It's not that big tech is bad, it's that the price got expensive. Overvaluation fear is really future returns look lower fear, not doom fear. So the trade became rotation, shifting from crowded growth into broader, cheaper assets. First alternative, small caps, publicly traded companies with a market capitalization between $300 million and $2 billion. They are more domestic and more sensitive to growth. Small caps can benefit if financing conditions stabilize and the economy avoids recession. Next, industrials, tied to real investment, infrastructure, and demand for physical capacity. Industrials often lead when markets believe growth is okay and policy is predictable. Defensive consumers also shine because they sell essentials when people feel uncertain. Defensive rotation isn't bearish, it's a way to keep exposure but sleep better. On the other hand, if you think the economy will perform, cyclical stocks like materials and financials can work. Gold is another destination, a hedge when the dollar wobbles or confidence fades. Gold prices have skyrocketed recently due to central banks buying it and steady demand from countries where the metal is very popular, such as China and India. Gold prices will probably stabilize for a time, but there's still room for profits. But here's a key nuance. Rotation is not risk-off, it's a hedge against drawdowns. Risk-off is sell everything, pile into cash, treasuries, and hide from volatility. Rotation is stay invested, but reposition where expectations and valuations look healthier. The market can rotate even while staying broadly constructive on growth. One way to check: credit spreads and volatility don't scream panic right now. High-yield credit spreads staying tight implies default fear is not dominating sentiment. If credit remains calm, the market isn't pricing a near-term financial accident. Same with VIX. If it's steady, investors aren't paying up for crash protection. So how should one position conceptually? Think in baskets, not single tickers. Basket 1, keep core equity exposure but reduce concentration in the biggest names. Basket 2, add breadth exposure like equal weight, value tilts, and diversified sectors. Basket 3, add a hedge sleeve like gold or defensives, sized for your risk. The takeaway? 2026 is about breadth, valuation discipline, and smarter diversification. Hit like and subscribe if you enjoyed the video and turn on notifications for more info.